To help us understand what's going on, what should be front of mind for Australian investors, or at least what's front of his mind, Martin Crabb is joining us from Shaw Partners. Hello.
Hi Nadine, how are you?
Very well, thank you. Look, I'm faring better than the bond market. You know, we continue to see volatility, but bond yields pushing higher.
Yeah.
We know why. I mean, US Fed. So how are you thinking about what's going on there now?
Yeah, the bond market's really interesting. We've got a very rare phenomenon. We've got an inverted butterfly yield curve.
Okay, so I've heard inverted. I haven't heard butterfly.
Yeah, so
please explain.
Butterfly's wings are normally pointing upwards, right? So it's U-shaped. That's the butterfly. An inverted butterfly is where the short rates and the long rates are lower than the mid rates, so the wings are pointing down. That very rarely happens. It's normally slopes up. Because basically you want a higher interest rate in the future to pay for the uncertainty, or if monetary policy is really, really tightening up, it goes inverted, and that's typically your recession indicator. We've got a little bit of a Frankenstein of those two phenomenon where we've got a inverted butterfly. So it points to a few things. One, it's, as you said, it's volatility. The market doesn't know what's going on. It's a strange kind of shape for a yield curve to be. Secondly, it points to perhaps a policy misstep by the Fed, i.e. they increase rates too far too fast.
Causing a recession.
That cause a recession, killing inflation, which is why the long-term interest rate is lower than the medium. And thirdly, it says the market thinks that monetary policy will be at its tightest at the end of 2023, because it's sort of 3-year bonds, 2 to 3 year bonds that are the fat part of the belly, if that makes sense. So there's quite a lot going on in the bond market, but overall, it's been carnage. The Bloomberg Aussie bond index, I think when I last looked, is down 4.5% for the month. This is a place you're supposed to hide your savings when things get tough. There's a war kicking off in Europe. I'll buy some bonds because it's safe. You've lost 4.5% of your money. Aussie equities, on today's numbers, up 6.5% this month. There's been a 10% difference between bonds and equities at a time that there's a lot of uncertainty in the world. The Fed's hiking rates. You know, there's so much going on, and that's not supposed to happen.
The brave have said on this channel, look, it's confusing. I don't know what's going on with equities really out there. I mean, you can't say that at CIO, Shaw Partners, but it is an unusual situation.
We always know what's going on. We always know what's about to go on. That's why we get paid what we get paid. Now, look, it's interesting from the market's behaviour. It's not doing what it's supposed to do in that the bond market is telling us to be worried about growth. The bond market's obviously telling us to be very worried about inflation. So if we have slowing real growth and rising inflation, that stagflation thing that we keep hearing about is horrendous for equity returns historically, horrendous. We're talking 40, 50% downturns in that scenario. And yet here we are with the Aussie market up 6.5%. So we are obviously catching the inflation hedge side of that. So, you know, if you're producing nickel or ammonium nitrate or copper or iron ore or whatever, you are making hay while the sun shines, and so that part of the market is obviously holding us up. Lithium's another one I should throw into that group as well. So our market's proving to be a good inflationary hedge in the short term, but people are now starting to think, well, should we add some duration? So performance of tech's really interesting. Tech's up 10% this month. It's doing better than the market, and that's a duration play. So they're long duration stocks. So as the long end of the curve, the yield, and this all tied to the bond market, as long end of the yield curve becomes more attractive, people will start buying long duration stocks. So we've seen things like Square or Block. Today you had Aristocrat. We've had reasonably good bounces in quite a few of the growth names.
Appin, Tyro, Megaport, you know, now that this has come to life, thank you. Infotech is up by 3.5% today.
Just today. Yeah.
So people have also been buying the banks though.
Yeah, look, I'm not a fan there. I think Commonwealth Bank's probably one of the most overpriced stocks I've seen. Why do I say that? Well, I look at banks as a bond proxy. They're not going to give me a lot of income growth. They're pretty much unregulated monopolies, although there's lots of regulation. And they pump out, you know, somewhere between 10 and 15% return on equity. They don't have a lot of growth, so they pay out a lot of their earnings as dividends. And they're basically tied to the housing market, which is topping out. I mean, it's clear that with interest rates rising, property's not going anywhere. So without net migration, our property market ain't growing. So our banking sector's not growing, credit's not growing. So these guys aren't going to grow. So it's really a cost out story. And I look at CommBank and go, that's not a cost out story. Westpac it is, ANZ it is, even NAB it is. CommBank's not a cost out story. So why are people paying 20 times earnings? So we've looked at the PE ratio of this thing back to when it IPO'd in 1991. It's never been at 20 times before. And yes, okay, rates are low, but they're going up. So if you take the equity yield, so if CommBank paid out all of its earnings as dividends, it'll be on about a 5% yield. So that's the earnings yield. If you take the bond rate off that, it's only 2%. So that's pretty low for a bank with not a lot of growth. So it should be 4 or 5%, we think. So we think the PE of CommBank should be materially lower than what it is, and we can't see the earnings growing. So I think that's one stock that just stands out. It's up 10%, 15% this month, and it shouldn't be.
So you're saying take profits?
Take money out of CBA in particular. The other banks don't look as bad, but I think the whole sector, you probably want to take money out. But CommBank, certainly if you've got index weight or more in that, which is 8 or 9% of your portfolio in CommBank, take some money out of that, definitely.
Where would you put it?
Anywhere else. You know, we still like energy. We think energy's still got legs, and we really want to protect our clients against inflation. So there is a scenario that sees $200 oil. There's a few people talking about $200 oil. If that happens, the only thing that's going to go up in your portfolio, maybe gold, is energy. So in that environment, the bond market gets killed and bank shares will get killed too. So hedge that risk by buying some more energy. So we've got lots of energy already. We still think that's a pretty safe place to be.
Woodside,
Santos.
Yeah.
Yeah.
Why only the big players?
Oh, because you get a really good spread of assets. With Santos buying Oil Search's assets, that gives it growth.
Yeah.
It didn't really have growth before that. It had cash flow, no growth. And Woodside buying BHP's petroleum assets, give them cash flow. They had growth, no cash flow. So I think they're two transformational transactions, but they're also big, liquid, easy to get in and out, and they are pretty much correlated with energy prices.
So overweight the energy sector. Are you tempted to buy some BHP, even though it's reducing its exposure to energy? I mean, even if you're thinking about yield, dare I say?
It's really interesting. So my colleague Peter O'Connor says, health warning, never buy a resource stock for a dividend yield. Don't chase the dividend. But if you happen to own it and it pays a dividend along the way, then that's great. BHP is really interesting because it's about to pay sometime in May or June. It's Woodside share. It's going to pay Woodside shares to its shareholders as a fully franked dividend in exchange for the BHP petroleum asset sale. So it's about 0.18 Woodside shares per BHP roughly. It's about $6 a share as a fully franked dividend, which is great, on top of their ordinary dividend, which is going to be another $3.50.
So you're getting that Woodside exposure.
So you're getting a $10 fully franked dividend in the next 12 months from BHP, which is what, $40, $50. So it's a 26% grossed up yield. Again, never buy them for yield, see the health warning, all that sort of stuff. But I just think that, and iron ore is obviously performing a lot better. Like one big broker put its sells on Rio and Fortescue to neutral because it said this iron ore price is going to stay high for longer. So we're not a big fan of iron ore longer term, but I just think the BHP story is compelling in the short term.
Martin, where will you be at 7:30 p.m? Will you be glued to your screens?
I won't be. I'm a coach of the Northbridge Men's All-Age Division 2 team. We'll be training tonight on a synthetic pitch despite the rain, so I'll be doing that. And I'll be reading, no doubt, the brilliant, concise analysis of the Ausbiz team and other groups afterwards.
Well, we will have a program you might want to watch from 9 o'clock tomorrow. We'll be speaking with the Federal Treasurer as well. I mean, really, the impact immediate on companies is muted. I mean, we'll get some spending in infrastructure. We might see a bit of a bounce there. Defense, cyber security. Yeah. You know, maybe something on aged care. We haven't heard much yet. Child care, but it's not really a market mover. No,
I mean, we're a $2 trillion economy, and even $100 billion worth of spending is just not going to turn the dial. In Australia, we're such a macro-driven economy that changes to fiscal monetary policy, unless they're aimed at things like imputation credits, which you saw in the last election. Unless there's changes to super or imputation credits or something, the market tends to do a big yawn. There'll always be winners and losers. Like defence spending, there's only a handful of defence stocks in the market, so maybe they get a little bit of a boost, depending if it's aimed at shipbuilding, for example. But for most, as you said, for most cases, and they announced this big number, but it's over a decade. Oh yeah, and then 40% of it disappears in terms of admin. So you never get the bang for your buck. Particularly with infrastructure, right? Exactly. Okay, so when you come in after budget and after you watch our coverage tomorrow, the conversation will turn to election. Yeah. I don't think it's too early to ask. What usually happens to the Australian market around federal elections? Yeah, it tends to, I mean, the markets hate uncertainty. It's the same with the US midterm elections. The market always underperforms in election year. So there's definitely some uncertainty and risk premium built into the market, but it's difficult to see what it is. And even though the polls may suggest, a change of government, you just never know in Australian politics. And there are so many people now who are making up their decision on the day, let alone sort of months or weeks ahead. So there is really a massive difference between the policies from a market's perspective. There might be a big difference between the policies on political agenda, but in terms of what the markets look at, they're kind of fiscally responsible. They both want to balance the budget. No one's sort of out there, announcing massive kind of spending plans. So I think it's a bit of a yawn, to be honest.